If you truly want to understand the real engine driving modern civilization, if you want to see the quiet machinery beneath the world economy, machinery so vast and so hidden that most people will live and die without ever seeing it, then you must begin with one question. If every country is drowning in debt, if every government owes trillions, if nations across the planet are borrowing money at levels no one can comprehend, then who, exactly, is the creditor? It is a question that seems simple, almost innocent, but the moment you look deeper, the moment you peel back just one layer of the structure, you find yourself staring into something far more complicated, far more mysterious, and far more unsettling than anything you learned in school. Because debt is not just numbers. Debt is power. Debt is control. Debt is the invisible chain binding nations, institutions, markets, and billions of people into a system that no one fully understands, but everyone depends on. And this system did not appear overnight. It evolved over thousands of years, beginning with ancient civilizations that discovered something profoundly dangerous. If you control debt, you control people. The Romans learned this early. In the early republic, debt was personal. If you owed money and couldn't pay, you could be enslaved. As Rome matured, debt shifted into something larger. The Roman state began borrowing from wealthy elites, promising them interest payments funded by taxes collected from ordinary citizens. This model, the rich lending to the government taxing the public to repay the rich, became so profitable that wealthy families demanded more military expansion, more tax collection, more population control, and more state dependence. The empire's growth was fueled by debt, its armies paid by debt, its elites enriched by debt. And when the empire finally became too large, when the cost of maintaining it exceeded the revenue it produced, Rome did what every empire eventually does. It debased its currency. It printed money. It borrowed more. It postponed collapse by sacrificing the future. And the people paid the price through inflation. Does this sound familiar? It should. Because today, every major nation, from the US to China, from Japan to Europe, has built its entire financial identity around sovereign debt. Governments borrow money through bonds. Investors buy those bonds expecting interest. Central banks control the flow. But unlike Rome, modern nations have a trick Rome never had: the ability to create their own currency and borrow in that currency. And out of this innovation came the most powerful financial illusion ever devised: a system in which governments borrow money from a system that they themselves influence, using money created from nothing. What happens next is almost unbelievable. When the US government spends more money than it collects, it issues treasury bonds. Banks, pension funds, insurance companies, and foreign governments buy these bonds. But when they don't buy enough, when demand falls short, the Federal Reserve steps in and buys the bonds itself. How does the Federal Reserve buy them? By creating new money electronically. No printing press. No gold. No limits. Simply numbers typed into existence. That new money flows into financial markets, inflating asset prices, enriching the wealthy, fueling speculation, and creating the illusion of prosperity. Meanwhile, ordinary people face rising costs, stagnant wages, declining savings, and a future that feels less stable each year. And yet, despite the contradictions, despite the impossible logic, the system continues because everyone believes it must continue. The United States owes money to itself. Japan owes money to itself. Europe owes money to itself. China owes money to itself. Nations buy each other's debt to maintain stability. The US buys Japanese bonds. Japan buys American bonds. Europe buys US bonds. China buys US bonds. Pension funds buy everything. Central banks buy what pension funds don't. And so when you ask, who owns the world's debt? The answer becomes clear. The world owns its own debt. But that answer doesn't satisfy the deeper question: where does the debt ultimately end? Debt must rest somewhere. Someone must be the final creditor. But in a system where everyone owes everyone, the creditor becomes invisible, because the creditor is not a person or nation. The creditor is the system itself. This system, complex, interconnected, global, runs like a machine. Central banks coordinate silently. Governments pretend to be independent, though their economies hinge entirely on the debt market. Corporations take advantage of low rates to borrow endlessly. buying their own stocks to inflate share prices while workers struggle to afford homes, education, and healthcare. Debt becomes the fuel. But like any engine running too hot for too long, cracks begin to form. History shows that no debt-based empire has ever survived indefinitely. The Roman Empire fell when its debt surpassed its ability to tax. The French monarchy collapsed under massive borrowing that funded wars and extravagance. The British Empire lost its financial dominance when it could no longer sustain the cost of global military presence. And today, the world is entering a similar stage. Global debt has surpassed $350 trillion, far more than the productivity of every nation combined. Countries borrow not to invest in the future, but to pay for the past. They borrow to pay interest on old debt. They borrow to keep social programs alive. They borrow to avoid political backlash. And when borrowing becomes too large, central banks intervene to prevent collapse. But every intervention creates more imbalance. Every rescue encourages more risk. Every bailout deepens the dependency. And as dependency grows, nations lose control of their future. The US dollar became the world's reserve currency after World War II, giving America unprecedented financial power. Nations hold US dollars as reserves. They buy US bonds because the dollar is liquid, stable, and backed by the largest economy. But the dollar's dominance creates a strange paradox. The US can print money and export inflation worldwide. When the US prints dollars, foreign nations holding dollars lose purchasing power. But they accept this because they need the dollar to buy commodities, run trade, and stabilize their currencies. So the US borrows endlessly. Other nations absorb the impact, and the cycle continues. But what happens when other nations lose trust? What happens when China reduces US bond purchases? What happens when emerging nations move toward alternative systems? What happens when interest rates rise and governments must pay more to service their debt? These are not theoretical questions. They are happening now. Nations across the world are reaching debt levels they cannot sustain. Japan's debt is over 250% of its GDP. Italy's is over 140%. The US debt is nearing $40 trillion. China's hidden local government debt is enormous. And behind all of it lies one silent truth. Governments cannot pay these debts back. They can only roll them over, refinance them, delay them, or inflate them away. Inflation becomes the easiest path. Inflation punishes savers. It punishes workers. It punishes the middle class. But it protects the system. It allows governments to repay their debt with money worth less than when they borrowed it. And as long as people continue working, spending, and believing in the currency, the illusion holds. But illusions do not last forever. History shows that once people lose faith in their system, once they realize that their savings are being eroded, once they understand that their future is mortgaged, they begin to question everything. And when enough people question, systems shake. The Great Depression, the 1970s inflation crisis, the 2008 financial collapse, all were moments when the illusion cracked. And today, the cracks are returning. Inflation is rising globally. Interest rates are unstable. Nations are struggling to maintain their currencies. Political polarization is rising. Social trust is collapsing. And beneath all of this lies the same question. If every nation is in debt, who is the creditor? The answer becomes clearer the deeper you look. Future generations. They are the ones who will inherit the consequences. They are the ones who will pay for the decisions made today. They will inherit larger debts, weaker currencies, slower growth, and fewer opportunities. Their taxes will fund interest payments on money borrowed decades earlier. Their purchasing power will be lower. Their financial stability will be weaker. They will work longer for less. And they will question why they inherited a system built on endless borrowing. The truth is simple. We are borrowing from tomorrow to survive today. And tomorrow is catching up. Nations will be forced to confront the limits of debt. Some will default quietly through inflation. Others will reorganize their financial systems. Some will face social unrest. Others will create new alliances. But none will escape the consequences. Debt has been the engine of global power. But it is also the weight pulling nations down. And when the world finally reaches the point where the engine can no longer run, when the debt becomes too large to refinance, when trust fades, when currencies weaken, when the people finally see through the illusion, everything will change. Until then, the system continues, silent, powerful, relentless. And now you understand the truth. Every nation is in debt because debt is the foundation of modern civilization. The creditor is the system itself, and the future is the collateral. Imagine peeling back the surface of history and realizing that behind every empire, every revolution, every golden age, and every collapse, there was always a small circle of people who understood one thing better than everyone else. The secret that power does not come from armies, or land, or even gold, but from controlling the flow of obligations that bind one person to another, one nation to another, one generation to the next. Because if part one revealed how debt became the most profitable product in human history, then part two reveals something far darker: how the elite deliberately designed, manipulated, and weaponized that product across centuries to maintain dominance, reshape civilizations, and steer the world's wealth into their own hands while millions lived under the illusion that governments and financial systems existed for the common good, never realizing they were participating in a game whose rules were written long before they were born. And to understand how the elite perfected this playbook, you have to return to the earliest organized states, where rulers discovered that violence alone couldn't hold societies together. You needed predictable revenue, and predictable revenue required people to owe something, because a citizen in debt is more obedient than a peasant with nothing to lose. The ancient kings of Mesopotamia learned this early. They taxed grain to force farmers into borrowing during droughts, then forgave debt only when uprisings became likely, maintaining a delicate balance between desperation and survival, a calculated strategy that ensured the crown stayed in power while peasants believed they'd been saved by the same system that ensnared them. As civilizations advanced, elites refined these techniques. In ancient Rome, the senatorial class, wealthy families whose power rested on land and finance, engineered cycles of credit expansion and contraction to seize the property of soldiers returning from war. The pattern was simple: lend heavily during prosperous periods, raise interest when the economy dipped, then buy up the land of distressed borrowers for pennies. The Roman Republic never fell because of foreign armies. It collapsed because the elite financial class extracted so much wealth from the middle that ordinary citizens had nothing left to defend. Julius Caesar's rise was fueled not by charisma alone, but by a population crushed under debt, who rallied behind the only man promising reform, proof that debt crises have always been political tools long before they become economic disasters. When Rome fell, the strategy did not disappear. It simply changed hands. Medieval European monarchs relied on Jewish and Lombard bankers to fund wars and dynastic rivalries, granting them privileges during peacetime, then expelling them and seizing their assets when repayment became inconvenient. Debt was a lever. It built cathedrals, financed crusades, and concentrated land in the hands of nobles who rarely touched a plow. But the most sinister development came when elites realized they no longer needed to lend their own wealth. They could lend using the wealth of the public and extract interest forever. This realization reached its first perfect form in Renaissance Italy, where families like the Medici mastered double-entry bookkeeping, allowing them to track obligations with mathematical precision. They lent money to kings, popes, and merchants, using credit as both weapon and shield. Their real genius wasn't in banking. It was in creating the illusion that rulers depended on them, when in reality they controlled rulers by determining who received funding and who didn't. Wars were won not on battlefields, but in counting houses. Historians later tried to romanticize this era as a period of innovation, but the truth is simpler. The elite discovered that whoever controlled the ledger controlled the world. This system reached industrial strength in the Dutch Republic, where for the first time in history, ordinary citizens were convinced to fund state power by purchasing government bonds, believing they were participating in national prosperity while actually underwriting the expansion of a merchant elite whose trading companies became early prototypes of modern corporations. The Dutch East India Company, often taught as a symbol of global commerce, was essentially a weaponized debt machine, selling shares and bonds to finance armies, fleets, and colonial domination. The bondholders, not the citizens, determined policy. When England copied the Dutch system and created the Bank of England in 1694, the elite playbook became permanent. Governments would fund themselves by borrowing from centralized institutions that they themselves empowered, locking entire nations into perpetual interest payments that flowed upward into a small financial aristocracy. This was the moment when elites stopped reacting to economic cycles and instead began engineering them. The South Sea Bubble, the Mississippi Bubble, and countless less famous crises were not accidents, but carefully orchestrated schemes in which insiders inflated markets using propaganda, sold at the top, then bought assets back after the crash at fractions of their former value. Every crisis widened the gap between creditors and debtors. Every bailout strengthened elite control. And every explanation offered to the public was a lie. By the 19th century, the British Empire perfected the technique. It used gunboat diplomacy and opium trafficking to force open markets, then infected colonized nations with foreign debt, ensuring they remained dependent long after the flags came down. Egypt, India, China, entire civilizations were pushed into insolvency, not because they were poor, but because debt gave the empire the legal right to dictate their economic policies. The elite discovered the most efficient form of conquest, lending money to a country, making it dependent, then using that dependence to seize resources, ports, and political influence. And while the British did this abroad, their own upper class engineered domestic reforms that protected capital while keeping workers indebted. Peasants forced off land became factory laborers whose wages barely covered rent, ensuring landlords captured most of their income. The poor didn't remain poor because of laziness. They remained poor because the entire system was built around obligations they could never outrun. When the United States inherited global leadership after World War II, it didn't create a new system. It inherited and upgraded the old elite playbook. The creation of the IMF, the World Bank, and the U.S. Treasury dominated global financial order institutionalized debt as a tool of international control. Nations were given loans with conditions written by economists who never set foot in the countries they controlled, demanding privatizations, spending cuts, and currency devaluations that transferred wealth from local populations to foreign creditors. And while the world focused on geopolitics, the American elite quietly built a domestic financial empire. Banks lobbied for deregulation, allowing them to expand credit far beyond deposits. Political parties became dependent on donations from the financial sector, ensuring that no meaningful reform would ever pass. The Federal Reserve evolved into a machine capable of shifting trillions with a single announcement, enriching asset holders while wages stagnated. And through it all, the public was told that debt was opportunity, credit was freedom, and economic cycles were natural, when in reality, every part of the system was calibrated to keep ordinary citizens in a state of perpetual repayment while elites extracted wealth without producing anything tangible.